Hello, this is Steve Malone with Comps of X. Hope you're doing well today and you're getting some good trades. In yesterday's video, I talked about waiting for a range breakout in an illiquid market. We had the Martin Luther King holiday here in the U.S. and U.S. banks and stock markets were closed. And we found the euro dollar and the Aussie dollar in very tight ranges. And I suggested instead of trying to trade in a tight range is to wait for the range breakout. And most likely what you want to do is look at the moving average on the bigger picture and look to trade in the direction of those longer term moving averages. So I'm going to do a quick review of what took place. You can see here that we had a very tight range yesterday, had a high about 33.30 and a low was just below 133. And with a 30 pip range here and an average daily range of about 93 pips, that's pretty tight. Instead of getting inside of this and getting chopped up, wait for the market to break the range. And most likely the market will break and move in the direction of the longer term moving averages, or what I often refer to as the big picture. And here we have the 10-day and the 21-day. Now they've updated a bit today, but still the 10 days above the 21-day, and that's the direction the market went. It went in the direction of the longer term moving averages. The 10-day and the 21-day exponential moving averages are a couple of moving averages that professional traders monitor to determine the direction of the marketplace. The 10 days over the 21-day, you're looking to go long. 10-day below the 21-day, you're looking to go short. And that's exactly what the market did. Now, what did the market go to? Well, I mentioned look for the market to go up to the average daily range weekly mid-high target, which was 133.69. Bam! That's exactly where it went to. Then the market pushed down, and look what it did. It came right back to the downside, hitting the weekly mid-low. Then decided to bounce back up towards the weekly mid-high. A lot of back and forth. No clear direction in the marketplace as of yet, given some of the volatility in the marketplace and some of the comments from the BOJ and from the ECB. Now, with all this being said, there is still the potential to see the euro dollar continue to push on up towards 134, back up to these highs we had last week. So again, when you find yourself in an illiquid market, instead of getting into the chop, look for a breakout and look for that breakout to be in the direction of the larger moving averages. We'll take a look at the Aussie dollar. Same situation yesterday. Here's the high and the low. So the high coming in right about 524, the low coming in about 490. Still about a 30 pip range here. Not a whole lot going on here. Instead of getting inside this and into the chop, the market did make a break to the upside in the direction of the 10-day and 21-day moving averages, and the market went beyond the weekly mid-high target of 535 and pushed up to what I thought it might do, coming up here to the 565. Now there is the thought that this could potentially continue pushing on up towards this level up here that was right around the 106 level that we saw in early January. So there's the possibility that we get this push on up from here, kind of this double bottom effect, and see a push higher. And looking at the Traders Dynamic Index, looks like it's potentially trying to go that way. We came back towards the market baseline and bounced off of it, heading higher. Let's go take a look at the pound dollar. Now the pound dollar has an average daily range of 99 pips. Over the last couple of days, we've seen the most of the range be about 87 pips. So on top of that, it's tightening down. You can see how this is moving up. We have higher lows. We have basically some lower highs. So the market's tightening down a bit. I do expect there to be a potential push in a particular direction on the pound. Now some are estimating, because we've had such a move down over the last number of days. You can see here pretty strong move down all the way from 163, and from this swing low to swing high, we've moved about 200% extension here down to about 158. Some in the marketplace are looking at the potential that we'll bounce off this weekly mid-low, and you see you have kind of a triple bottom here, and push higher. However, if you look closely, you can see that the 10-day is below the 21-day. let me clean this up just a bit here. I'll take the fib off, and you can see that here's the 10-day at 59.66, and that's below the 21-day. This would suggest a possible continuation down. If you go out and take a look at the daily chart showing a pretty strong double top pattern, and we're seeing right now at the midpoint of that pattern. So a break of the midpoint, we would see the market potentially come down and test this low sitting right about 57.60, and then look for it to continue moving on down, possibly all the way down here to this trend line, which sits somewhere in the neighborhood of around 155.85 to 156 area. Taking a look here from this low point to the swing, from swing low to swing high, the 127.2 comes in at 56.88. The 141.4 comes in right at the 156 level, and then the 1618 comes in at 55.21. If we get a continuation of this move down, look for the market to go to 57.60, 56.88, then on down possibly to 156, and then that will be at the top of this range area right here. You see this range back here? So I would expect if the market's going to continue to the downside, we find ourselves caught up in this range and possibly bounce off of this trend line, which is actually goes back to a weekly trend line, and you can see pretty strong trend line to see a possible bounce back up. But again, it all goes back to what we have going on right now with not necessarily an illiquid market, but a market that's not really certain which way it's going to go. Some are anticipating a push lower because of the large double top that we see on the daily, while some see the fact that we've moved down from 163 all the way down to 158. That's about a 500 pip move down with no major retracements. So some are anticipating a possible push back up to 159, possibly even back up to 160 before pushing lower. So again, in this case, mark your high and low of the range, and keeping it fairly easy, if we were to break the low point here, the 58.0706 area, look for the market to push down towards the weekly low target down around 57.68, and then lower, as I suggested on the daily and weekly charts here. Going again back down to the daily chart, might see a push down to 56.88, then on the way down towards 56. Well, folks, this is Dean Malone with CompositeFX. Hope some of this information will help you out. And again, be aware that when you're in an illiquid market, very tight range, especially when your range is quite a bit less than the average daily range. You can see here was 93 pips, and here we are in about a 30 pip range. Don't get inside this and trade it. Look for the breakout and expect the breakout to be in the direction of your larger moving averages. Well, this is Dean Malone with CompositeFX. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.